Our first speaker today is Raymond Kim, and will presenting his work on hedging securities and Silicon Valley Bank idiosyncrasies. Raymond is currently an assistant professor of finance at the W.A. Frank College of Business at Northern Arizona University. Prior to academia, Raymond worked in investment banking at JP Morgan, statistical arbitrage at Virtue Financial, interest rate analyst at Omega Advisor affiliate, and derivative strategist at Mirror Asset Securities. His research interests include banking, derivative hedging, corporate finance, and capital structure. Please join me in welcoming Raymond to the stage. Thank you, Raymond. Yeah, there is.
Okay. Thank you for the introduction. Thank you for this opportunity to present my paper here. It's the first time I've been to a conference where every paper I'm just completely focused and listening. I appreciate the chance to come here. Thank you for picking papers based on content. So my paper is about hedging securities and Silicon Valley Bank idiosyncrasies. Silicon Valley Bank had a zero hedge strategy. So in a rising interest rate environment, Silicon Valley Bank amassed 124 billion in bond security portfolios with zero hedges. This is like, I mean, you could see the headlines. How crazy was Silicon Valley Bank's zero hedge strategy? And that really kind of captures the essence of this paper, is trying to figure out how crazy was this strategy. So on March, just a quick summary, March 8th, Silicon Valley Bank lost 1.8 billion selling their 21 billion available for sale portfolio. So they lost quite a bit. And then the same day after that loss, they announced equity offering. Hey, they need to make equity raise to, fill in this big hole that came, and that failed. So the investors are like, they got 103 billion of held to maturity securities. And, it's just, you don't know what's happening down the line. They're not hedged. And it's just, who's going to invest in that, right? So by the end of March 9th, a day later, Silicon Valley Bank, and of course, being in Europe, the time, you'd rather, kind of enjoy your day at night instead of following this. So just kind of hopefully, so you could kind of capture the craziness, but the stock tanked 60%, uninsured depositors, they rushed to withdraw funds that day and the next day. I really like this quote. It's, if Silicon Valley Bank had 15 billion of its available for sale portfolio hedged, it likely wouldn't have failed because there would be no crash. So just to kind of review, securities are held in two buckets: available for sale is unrealized losses, and that is counted in net income. Held to maturity, those unrealized losses are not counted in net income. So you could just kind of hold on to it and say, well, when it matures, that's where, we're getting our money back. So, we didn't need to count their losses. Silicon Valley Bank, 90% of its deposits were uninsured. This is pretty big. I guess from in the EU, deposits are not insured anyways, but compared to other banks, this was a really big aberration for Silicon Valley Bank. 55% of its assets were securities compared to about 20 for other banks. So you could kind of just get a sense of how unusual this is. So the question is, did other banks hedge their security losses in their held to maturity available for sale portfolio? And I'm specifically focusing on banks below 250 billion in assets because, as you've seen in prior papers, everything above 250 billion, there's already a lot of stress tests, very much detailed data. There's already a lot of eyes on those banks. But Silicon Valley Bank was just below the 250 billion threshold. So this focuses on all banks below 250 billion in assets. So how do banks hedge interest rate risk? Just to kind of, just a quick, just to visualize. So if a bank enters into receiving float, so they receive floating payments, let's say every 6 months. Let's say they say we're going to receive, a secured overnight financing rate plus 400 basis points. So they're right now, if we say secured overnight financing rate is 25 basis points, they're receiving 425 basis points in interest payments. So now let's say interest rates go up to 4.5%. Now they're receiving 8.5% on that floating interest rate hedge. So as that swap rises in value, because that swap will, the value of it increases, that partially offsets your losses in your securities portfolio. So the Silicon Valley Bank, they sold their very last hedge in 2022 Q4 for profit. So that's not what you do when you're hedging. You don't sell your stuff for profit. That's trading. Okay, so that's profit taking, not trading. And so that question is also, did other banks sell their hedge when interest rates rise? We could generally see the aggregated held to maturity losses. The aggregated held to maturity losses, we could see that, generally as these losses are piling up, that hedges did increase. And right around here when hedges actually increased was when, inflation started creeping in the middle of 2021 in the US because of, this Long Beach port. There was like 100 ships just hanging around out for weeks because, they couldn't, park their ship to. But anyway, that was kind of the beginning of this inflation. And, bond traders, especially bond vigilantes, as soon as you see inflation, you're expecting rates to rise. So you could kind of see that activity, and you could see the losses. It was anticipating these losses coming, in the future. And that's for held to maturity losses. Available for sale, you see the same thing. As you see a rise in hedging before the losses got really big. And that's what you would expect from fixed income hedging. Okay, so did banks systematically make Silicon Valley Bank's mistakes? First impression is, no, it doesn't seem to be that way. So banks are expected to hedge held to maturity available for sale losses as they go up, as when rates go up. Banks are expected to reduce hedging as, gains increase. It's kind of like what you might do when, when things are dangerous, you wear your seatbelt, you do more things for safety. When things, when the danger dies down, you might, be a little bit more relaxed. So, it just kind of makes sense. So asymmetric hedging implies discretion, that you're following, the forward rate guidance from the Federal Reserve, and you're trying to optimize your portfolio based on that forward rate guidance. So banks actively hedge these losses when funding risks are present, meaning uninsured deposits. So that's something that I also look into. So that there's an empirical gap in this risk management literature. So hedging requires adequacy and timing, and so far the academic literature has not looked at timing. So there's two critical gaps. One is the lack of research on bank hedging activity against losses in securities. There's a paper by McPhail, Schnabel, and Tuckman that examines 250 banks using individual swap data, and they find the net after everything kind of cancel each other out, the net exposure is negligible. But the problem with that paper is that these swaps do not distinguish between hedging and trading. So you can't net hedging and trading swaps and think that that's hedging, because these are completely two different things, and I'll show that in a little bit. Jing, Matvos, Piskorsky, and Saru, they find only 6% of assets are hedged, and I also find that, and I think that's kind of a general finding, that hedging assets are about 6% of total assets. So Pernandina finds banks hedge maturity gap risk. None of these papers actually look at the relationship between hedging and held to maturity available for sale losses on a timing basis. Drexler, Stavov, and Schnabel, they also find deposits act like long-term liabilities when matching with long-term lending. But the question is, what about uninsured deposits that kind of act a little bit more like short-term liabilities, not long-term? So we could, just to show why, this is banks over 250 billion in assets. They're hedging over assets percentage. So you could see that, these big banks are engaging in a lot more, hedging in the aggregate, whereas banks below it. And, I'm focusing on these banks right here. Okay, so the data from the call reports, 10-year swap rates and 10-year treasury rates, and we kind of go through that. So the summary of hedging versus non-hedging banks: hedging banks are larger and riskier, more loans, uninsured deposits, and less equity. So these banks are a little bit riskier, so it's a good thing they're hedging. Okay, so the hypothesis is banks use hedging and trading interest rate derivatives differently. So remember that paper where they're net swapping both hedging and trading together. So that first hypothesis is hedging and trading interest rates are different. Banks increase hedging when losses go up, decrease hedging when losses go down, gains increase. And banks increase hedging activity due to funding risks from uninsured deposits. So basically, hedging is the hedging decision is depending on available for sale loss, AFS losses, uninsured deposit interest rate guidance. Here there's some from the prior literature, maturity gap. I have a paper that also shows banks hedge for mortgage-backed security originations. In the U.S., mortgages take about 4 to 6 weeks to from beginning to finish. So during that time, the bank's exposed because they lock your interest rate. So there's an interest rate exposure, and they actually hedge against that. So here we could see that the dependent variables, the change in interest rate derivatives. Here's the trading. Here's hedging. We could see during periods of rising rates that trading sells swaps like Silicon Valley Bank. But we don't really see anything in the hedging category in relation to the changes in the 10-year swap rates. So that's kind of suggesting, well, hedging is not really, based on, trading against rates, but a little bit more bank dependent, on their bank balance sheet. So it's at the bank level. And that's kind of, although that if that's what you think, then this is what you would expect. And throughout all my charts, I cluster by bank level and time level separately. Standards. Okay, so we could see that. So I include from now on time fixed effects to account for potential hedging due to interest rates. So once we strip that out, everything left should be at the bank level, balance sheet level. So here we could see that the bank level losses, as losses are increasing, we could see that it's a positive, and as banks are bigger, they hedge more. Deposits, as deposits are going up, the banks are a little bit more, financed, and so they may not need hedging as much. So this is all kind of in line with prior findings. But here, in periods of rising rates, we could see that, okay, so when rates are rising and these losses are increasing, that's when this hedging activity, is positively associated. So as losses are increasing, as rates are falling, banks are hedging more. And in periods of falling rates, you see some of that too. Here's my mortgage origination variable, but it kicks out too many observations, so unfortunately I can't keep it. Okay, so here it's a two-stage selection model, shows that it's not due to sample selection bias. So is this asymmetric? So what about the individual security level, the different kinds of securities? We could see for held to maturity losses. Okay, so you do see when rates rise, as these losses increase, that there is more hedging. Not so much when rates are falling. So, held to maturity, kind of, well, is it really asymmetric? It's not as clear. But when you look at available for sale, you do see the asymmetric a little bit more, where as losses are increasing when rates are rising, there's more hedging. So more safety when it's kind of dangerous. And then when rates are falling and security values are going up, it's also hedging a little bit less. So yeah, you kind of tone down the security, I guess, when things aren't as bad. So here, what about funding risk? So we do see that the interaction between losses and uninsured deposits for hold to maturity losses, that's significant. So banks are increasing hedging when you have funding risks from uninsured deposits, as well as hold to maturity losses. That interaction is kind of showing, well, yeah, I mean, Silicon Valley Bank really did the opposite of what's systematically going on in banks below 250 billion. And we can see uninsured deposits here. As uninsured deposits are going up, banks are also generally hedging more. So these are all good things. So the conclusion, this addresses the gap in the literature regarding hedging and fixed income assets losses. Hedging has two dimensions, adequacy and timing. So literature looks at adequacy, but not necessarily timing. So banks below 250 billion asymmetrically do seem to increase hedging activity as losses increase, decrease when gains increase, but kind of more at the AFS level, not as much at the hold to maturity level. So asymmetric hedging implies banks are incorporating forward rate guidance. And the Heckman two-step selection model is implying that the findings are not due to sample selection bias. Banks are actively hedging these losses when funding risks are present. So Silicon Valley Bank selling its last hedge in Q4 2022 for profit, basically meant that they transitioned their hedging derivatives to trading derivatives. So it could, this evidence suggests that this may have been unusual enough where they should have reclassified that hedging derivative to a trading derivative, because that's what they did, when they sold it. Okay. Okay.
Thank you very much. We will now hear from our guest, Daniel. Daniel is the senior research economic market at Deutsche Bank. His research focuses on financial intermediation.
Hi everyone. Can you see my screen and can you hear me?
No. Hello. Sorry.
Hi.
So hello Daniel. So I was just introducing you. Sorry, my microphone was off. So I was saying Daniel is a senior research economist in the DG Markets and at Deutsche Bundesbank. His research focuses on financial intermediation, ESG finance, and systemic risk. And Daniel, the floor is yours.
Well, thanks a lot. So good morning, everyone. Thanks to the organizers for giving me the opportunity to discuss this interesting paper. I should mention that, given my affiliation, the usual disclaimer applies. So as Raymond pointed out, the collapse of Silicon Valley Bank and other banks earlier this year spurred a lot of research on bank runs, because essentially these events illustrated that, despite all the changes in bank regulation and supervision, classic bank runs are actually still possible. And funny enough, Raymond and I picked the same FT article in our slides. So in this case, the main insight was that in the presence of large, potentially unrealized portfolio losses, more information sensitive depositors, in this case uninsured depositors, may still have large run incentives. And of course, it seems pretty important to study this episode further to mitigate essentially the risk of similar episodes in the future. And a number of options are, of course, on the table. So, I mean, there are discussions about changing accounting standards, enhanced deposit insurance, and also risk management practices. And I think that Raymond's paper fits very well in the latter category. Now, here's my shortest possible summary of the paper. So, focusing on banks with assets below 250 billion. Raymond finds that these banks display differences in their hedging, in the timing of their hedging and trading activities. So regarding hedging, this seems to be more related to bank level risks, whereas trading seems more related to macro factors. And I do believe that this is indeed a very important research question. So, getting a better understanding of how banks manage their risk exposures over the cycle is indeed something that needs to be studied further. And in my comments, I'm going to be focusing on three broad areas. So one is about the sample selection and data. Second, I have some comments on the empirical setup. And finally, if time permits, I'm also talk about the policy implications. So as Raymond pointed out, he basically tosses the largest banks. So he tosses all banks with more than 250 billion in assets. And my initial response, when reading this about this data filter, was that this should certainly limit the economic relevance of his findings. So in a way, given the extremely heavy-tailed bank size distribution, dropping the largest banks may just limit the representativeness, say, of the sample. But actually, going through some related papers, I found this table in the Young et al. Paper. This table in the Young et al. Paper, where essentially you can see that indeed the largest banks make up around 55% of the total assets in the system. But to be honest, I would have expected an even larger number. So I think it would be important to, elaborate in the paper a little bit more on the economic relevance of these banks. How important are they along different dimensions? Now, the main justification for this filter that Raymond gives is essentially based on this figure 2 that he also showed in his slides, where essentially you can see that there are differences in the level of hedging versus total assets for the different groups of banks. Now, one thing I was a bit surprised was that he didn't conduct any formal tests. So I think with the data that you have, it would be very straightforward to test this in the cross-section of banks. But secondly, having a closer look at the figure, given that you focus on the sample after 2015, I think at least, a simple eyeballing approach indicates that there is some level of convergence in the hedging over total asset ratios across the different groups of banks. So maybe you can put a bit more explanation on why that might be. And in a way, I think it might actually be useful to keep the largest banks as a control group, at least for some of the analyses, if it's true that their risk management practices are more adequately supervised and monitored, if as you say. The next point that I'd like to make is that everything that you're doing in the paper essentially is based on hedging over total assets. Now, with this distinction between banks of different size, I found this additional bit from the table of Young et al., where you can see that the pattern might actually look quite different when you look at banks hedging over securities. So I wonder to what extent that might actually be the more relevant economic measure here. And, you might consider this alternative ratio, if you will, at least as a robustness check. And lastly, from my understanding, everything that you're looking at is based on gross notionals, right? But I can imagine that there are certain banks that do have offsetting exposures. So maybe looking at net notionals might also, from an economic perspective, be the more adequate measure to look at. So that's my take on the sample selection. Now let's move to the empirical setup. So hypothesis one, from my reading, is somewhat under-ambitious in the sense that it just states that hedging and trading IRD should be used differently in response to interest rates. I think you could elaborate a bit more on the economic mechanisms you have in mind on that. But let me focus more on kind of the main regression table that is presented regarding hypothesis one, which is this one. So I have a few comments on that. So the first one is essentially you're only interested in the contemporaneous coefficient, right? But looking at specification one, you see that the rates, the coefficient on the second leg essentially perfectly offsets the contemporaneous effect. And I wonder why you don't or why you wouldn't take that into account in the interpretation. Secondly, essentially you talk about changes in interest rates and then use 10-year swap rates as the interest rate measure. I understand that, as you alluded to forward guidance, that might capture that a bit more than, say, the Fed funds rate. But at least as a robustness check, I would have expected you to also look at short-term rates, or if you're worried about endogeneity, to look at monetary policy shocks. Third, I was a bit surprised to see that this regression does not contain any time-varying bank level controls. For example, you talked about bank size being an important measure as to whether banks engage in these activities in the first place. So you might want to include more of these controls, which could also help you with getting a larger R squared. And lastly, hypothesis one is essentially framed as, looking at differences in the coefficient estimates, say, between trading and hedging. But then you don't conduct any formal tests on whether there are these point estimates are actually statistically different from each other. Similarly, you differentiate between rising and falling rates, but then there's no test on whether the coefficients are indeed statistically significantly different from each other. And you could get around all of these problems by, for example, running a full sample estimation and working with different interaction terms, say for rising and falling rates, and then you can immediately see whether these differences are significant. Now, a lot of the comments I just made would also apply in some form or another to hypotheses 2 and 3. So I'm not going to repeat those comments, but let me just focus on equation 1 and the corresponding regression. You actually showed the results from that regression. So I think there may at least be the potential for some reverse causality here, because it would be pretty straightforward to write the same equation but use the security losses as the dependent variable and the hedging exposure as the explanatory variable. And I personally would find that regression actually rather interesting. So in a way, this would allow you to see whether banks with higher hedging or trading activity display larger or smaller securities losses. But actually, given the very first figure that you showed on, the time series of the security losses, it might be more useful to include the explanatory variables with the time lag to really work out kind of the direction of the relationship, and that might then also help you work out the effect on overall profits and losses. Finally, from my perspective, I think the paper at the moment is relatively light in terms of policy implications. So, strengthening the empirical foundation would actually help you to make much more specific statements, like what can we learn from the analysis, what are actually the trade-offs in terms of hedging and trading. And I hope that some of my comments were helpful along those lines. Now I look forward to reading the next version of the paper and wish you good luck with the publication of the paper. Thanks.
Thank you, Daniel. I will now open the floor for questions and answer questions. Yeah.
Thanks. So I guess my question is a little bit what Daniel also said. I guess it's a conceptual question. I'm a bit confused, Raymond. When I hedge, I'm supposed to do this to avoid losses, right? So ideally, I hedge ahead of time, right? So there's something about there's a causality question, I guess, hidden in this. But I'm just wondering, if I get forward guidance from my central bank, they warn me that rates are going to go up, and I have a lot of 30-year mortgages and 10, 20, 30-year treasuries hidden in my hold-to-maturity portfolio. At that point, then I should start hedging, right? And I should have lower losses, right? So there is this question as to what are you capturing, right? And that brings me back to you're doing the time versus bank fixed effects, right? So there's something about maybe that's the place where you can play to demonstrate that what you are capturing is in fact that banks are acting ahead of time, right? I hope. I mean, that's what it looks like when I look at your results. Yeah? Do you understand yeah? So we're back to the timing. So I'm not sure, maybe I misunderstand, but I'm a bit concerned that we're looking at maybe post-factual facts, right? Yeah.
I think we have another question.
Thank you for this very good presentation. I have one question on the distinction between hedging for HTM on the one hand and then AFS securities. The reason is the following: if you want to hedge, you actually want to reduce losses. But I wouldn't be surprised that also the empirical results are very different for these two categories, because if you hedge available for sale portfolios, then you are hedging losses which have a direct capital impact. For held to maturity, situation is a bit different. So as long as you want to hedge against increasing interest rates and interest rates increase, it's all fine because the hedge is producing gains. But what happens if we get a big economic shock? Suddenly the central bank reduces the interest rates and then the hedges are producing losses. and you don't have any gains to offset them because the gains are in the held-to-maturity portfolio, which has no capital impact. So I could imagine that banks treat this a bit different. What do you think about that? Thank you.
And maybe we have a question from the chat, Samuel.
Yes, from James Nugent. The Randall-Quarles reforms in 2018 lessened regulatory requirements for banks with assets below 250 billion in US dollars. This would seem to be a potential significant explanatory variable for the differences in the timing of hedging and trading activities in banks with assets below and above $250 billion. Is this something you explored?
I think, Raymond, you can take the question.
Yeah, thanks. I'm really excited to answer these questions because it's such a rare opportunity to talk about this from my perspective. So thank you for your interest and the questions. First, for the discussion, Daniel. My oldest son's name is Daniel, so so I appreciate your discussion a lot, tremendously. As you can tell, I wrote this paper by myself, so I almost now feel like you're there with me, because this has been a very lonely process for this paper. But yeah, you make really great suggestions. Yeah, and I'd love to have your slides so I could look into it a little bit more. I do look at in that first table with rates. I do look at short-term rates and treasury. I look at all the rates and it's all pretty much the same thing. But actually the results are a little bit stronger in some other rates. But I think I just have partiality to 10-year treasuries. So I used the 10-year swap rate just out of, that's just that's the rate that just the market is just so 10-year treasuries. It's just such a big rate in the markets that I just felt more comfortable using 10-year rates. But you do actually see stronger results with other rates. But I guess at that point I'm just like, well, am I picking for results or am I going to stay, intellectually honest with what rate is the most important in the markets? But yeah, I definitely, I'll try to, I'll write that. Maybe I could show different results, and that's like a good, I guess, the approach to it. Appreciate that comment because, I appreciate that. I really appreciate how deeply you looked into the paper. Yeah, I definitely will look at, I appreciate your comments. Hopefully, yeah, and I think, yeah, I did think about the interactions with the rising and falling rates, but this thing is just, I had to simplify as much as things as possible because I think you just get confused when rates are going in one direction and losses and then hedging, and there's just so many ways to make things really confusing. So I guess I just kind of wanted to just try to present it in that way, but I guess I could also look at the interactions too, and maybe that could kind of as a robustness check. I could definitely do that. I guess, let me see. Yeah, as far as policy implications, I mean, I guess it's just because, this is like my first conference I've been to that has a lot of, central bank and kind of policy oriented. So I don't know, I didn't really feel comfortable writing about policy stuff because I'm just like, I don't even know who's going to read it. I had no idea who's going to read it. I thought maybe nobody's going to read it but me. So, I could definitely do that, but I don't know, part of me just feels a little presumptuous if I do. But maybe, yeah, I mean, I definitely do have my thoughts. It's just that it's not something I'm used to considering. at the end of my paper. But yeah, I could definitely think about that. As far as the losses on swaps and hedging, so these held to maturity available for sale losses, they're just the losses on the security. They're not tying each swap to, oh, that swap applies to that security. They're not tying it. They're not mixing and matching the income gains from one with the losses for the other. So that's why I call it hedging activity, just to kind of as a general term. I would say just from, I have a lot of friends that do interest rate swaps. They're dealers at banks, and I think generally, like, you get, as on a daily level, right? You got risk managers, you got treasury departments at a bank, and they're looking at all the, all the models telling them where the exposures and risks in various scenarios are. And, they'll get a call from the risk management desk, the treasury desk, say, hey, we have this kind of exposure. When you're selling to clients, we want this kind of exposure. So maybe in that specific instance, they might, price it a little bit better to kind of have that kind of protection going forward at that moment, at that day, at that minute, as the market, as that exposure is, potentially, causing worry. So in that sense, yeah, the timing, because this is once a quarter. At the same time, at the end of the quarter, I'm sure, they're looking at all the swaps and saying, which ones do we classify as trading? Which ones do we classify as hedging? There's a whole stuff. There's all this stuff going on there that I think the timing question gets difficult. But that's also why I think that paper that I talked about previously, they had the swaps at the time of issuance and transaction. So, that's why it doesn't include the hedging or trading designation at that point. But at the same time, to net that at that point, I think it doesn't capture the hedging. Does that kind of address the losses question? Okay, so yeah, I guess yeah, if traders or hedgers if they are hedging, anticipating, but at the same time, their securities, it's being priced by the market. I mean, the treasuries, especially the mortgage-backed securities, they know that value at that moment, rates are changing, is also changing. So in a sense, even though we're looking at the security value and the losses at the quarter end, when they're hedging, they're also seeing it at that real time. So I guess, I guess as far as timing, I think that call from the risk management treasury department saying, hey, we have this exposure and we need to account for it with your with your clients. So I guess in that sense, they are reacting to that risk in their bank at that moment. But yeah, but that specific graph, yeah, you see it. I guess there is a little bit of a maybe I emphasize a little bit too much because I used to trade interest rate derivatives, so maybe I have a bias in trying to seem more prescient than, but yeah, but I definitely I'll try to address that going forward. Yeah.
Thank you. Thanks a lot.
Okay. And I guess with the Dodd-Frank question, the 6%, that's actually so it wouldn't be feasible for banks to hedge 100% of their securities because it's just not cost effective. So I think in a way, just like you might see somebody, if they're wearing a seatbelt, you just think, hey, they're like a normal, not crazy person. But you don't know for sure that they're 100% safe, but at least they're giving you a signal. And I think if you look at some of these quarterly earnings, when there's like a really big swap that the bank puts on, you'll see the analysts ask about it, like, oh, tell me about this swap. And I think you could kind of tell from the way they're talking about it, whether they understand what they're doing or not. A lot of banks in the U.S. from 1 billion to 10 billion, that range, a lot of kind of CEOs, they're just like interest rate derivatives, like, geez, what's that, And they're just smaller banks. So then, there's so I think there's a little bit of signal from that as well. Also, I do have a paper about Dodd-Frank and the 250 billion cutoff, and I show that banks, that smaller banks, because they have the access to regulatory information is so expensive, because the lawyers cost $1,000 an hour that know everything, all the lobby groups, what they're doing with Dodd-Frank, that the small banks, they don't know what's going to happen, whereas all the big banks do. So you actually see small banks reduce their hedging activity by half compared to big banks. So that's a cost of uncertainty that small banks bear that big banks don't, because of the cost of access to regulatory information as Dodd-Frank, because Dodd-Frank took 4 years to deliberate. But yeah. Okay.
Thank you, Raymond.